Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, October the 5th, and just going to take a brief minute to discuss what markets did last week as the large caps finally gave some back, with the S&P 500 finishing the week down 74 basis points, or down 0.74%. The mid-cap index, as measured by the S&P 400, was positive 26 basis points, or 0.26% on the week, and the mid-cap index, as measured by the S&P 600, was the leader, up 0.5% on the week, or 50 basis points. As we fast forward into this week, all eyes were on the 10-year Treasury, and as we started the day on Monday, the 10-year Treasury was at 4.63%, and had it move above 4.65, everyone warned that that was going to be a top on stocks and would create a market sell-off. And indeed, that's exactly what happened. The 10-year Treasury rushed up from 4.63 this week to 4.8%, which is a humongous move, and really closing the inversion on the yield curve to where it is now, with the 2-year just above 5%, and now the 10-year retreating a little bit today down to 4.7%. So what we have going on in the market right now is a couple of things. Remember, as we spoke last week, we're in the quiet period where a lot of companies are not going to be reporting a lot of corporate news ahead of their earnings. So it allows for markets to fluctuate and focus a lot more on economic data points, and a lot more speculation enters into the market until we really hear from these companies and get some fundamental earnings and what their outlook is moving forward. At River Place, we believe that we still are going to see a strong earnings season. We're not going to see earnings decline this quarter, and what we're going to be attuned to is what the outlook is for the rest of the year and moving into next year, and what companies are guiding to. So right now, just think of it as this way: as the 10-year goes higher, stocks go lower. If the 10-year goes lower, it's a chance for stocks to bottom out, settle out. We also seasonally are in the seasonally most weakest part of the market, going back 90 some odd years. So it's not a surprise. Markets tend to bottom middle of October. So these are all technical things that we're talking about. We're not talking about the fundamentals of the overall equity market, which is what we're going to get once we receive corporate earnings. The other thing that's happening is you're seeing mortgage rates increase as the 10-year makes this run up. And what we don't want to see happen is we don't want to see long ends rise so quickly and so fast that they actually surpass the 2-year and the yield curve's now uninverted. That is not a healthy sign. How you want to see the yield curve uninvert and shows a strong and healthy economy is for short rates to come down below the long rates. And that shows a healthy and soft landing of economic conditions. So what we're seeing right now is the Treasury market is determining it all, as the words recession have now come back in and people are now concerned again about recession. The good news is we're in restrictive territory, and we believe that the Federal Reserve is more than likely done raising interest rates. We got core PCE inflation last Friday at 3.9. That's the Fed's favorite indicator for how they measure inflation. So if rates are at 5.5% and you have the Fed's favorite indicator of inflation at 3.9%, falling below that very important 4% number, you're in restrictive rate territory, and relatively restrictive by 150 basis points. So all this impact has really hit the value sector and the small and mid-cap stocks the most. So if you have an equal weight portfolio, I wanted to touch on this briefly. If you are a value investor, the value sector just went negative for the year this week. The only thing propping the market up so far in the S&P 500 are these large cap growth and consumer discretionary names. It's about 7 to 10 stocks that are really moving the index higher. And if you hold all of those stocks, that's all you have in your portfolio, then you're doing great. But if you have an equal weighted or a diversified portfolio, it's okay if you're not outperforming the 500 at this point, because the value sector and small and mid caps are so far behind the large index. So as always, if you have questions about how to navigate this volatility with the Treasury and what to do until we start getting some earnings, call us. We'd love to talk to you. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. I hope you have a wonderful rest of your week. Thanks so much for watching.